Let's bring in David Kostin, Chief U.S. Equity Strategist at Goldman Sachs. He's bullish on stocks with an S&P 500 year-end target of 6,800. David, we'll broaden out to some of those consumer comments in a moment, but we have to first start with the elephant in the room. You are bullish on stocks, but we've already surpassed 6,800. Are you looking at raising your price target for this year-end?
Well, I think the thing you really have to start first is looking at earnings. What's happened to the results so far for U.S. corporate companies reporting? With looking at expectations was around 6% year-over-year growth. It's coming at 8% for the full year. The market's looking pretty strong in terms of the profit growth, and that's really been the story and the trajectory of the index. The broader index has been following the path of earnings. We're expecting earnings to grow into 2026. The expectation is that the Fed is likely to be cutting both this week and then in December and then twice next year. So that's 4 Fed cuts. And that's generally speaking been a tailwind for stocks when the Fed is in an easing mode, as long as we don't go into recession. That's not part of our forecast, meaning that we're expecting the economy to grow. The Fed's easing, and you have an environment where corporate earnings and guidance continues to be pretty robust. So I think those are the building blocks. When we look out, in a year's time, roughly 7,200 is a target that we published, and I think the backdrop remains pretty solid for equities in that context.
So, okay, so your target is 7,200 for a year out, next year, in October, November. What about earnings growth for 2026? Because you just said you're expecting now 8% for 2025. And is that a little bit of a slowdown? And does that slowdown continue in terms of earnings growth into next year?
Well, Matt, just to clarify, so the first half of the year, earnings were up 12% year over year. Expectation on consensus was around 6% for this quarter. And it's coming in roughly 8%. So we're getting a positive surprises. That's been pretty consistent in the last sort of 8 quarters, last couple of years, roughly 4 percentage points positive surprises versus expectations. And we look out this year, into next year, probably 7% is our baseline number, and probably the risk of that forecast is probably to the upside as opposed to the downside. I think the issue to think about is companies are really ramping up their capex. And so we look at the capital spending growth year over year is going to be this year, or looking into next year for 2026, be greater than the amount of capital they're directing towards buybacks. And I think that's indicative of the fact that a lot of corporate managements are pretty optimistic around their fundamental business, the potential for AI and adoptions that they're trying to do in different areas of their business practices. I think those are, generally speaking, Matt, some of the reasons why, from an earnings perspective, companies are likely to continue to grow their profits. And over time, that has been the driver of equity prices. Earnings drive stocks over time, and that's pretty optimistic. Last week we had a Goldman Sachs event in California. We had 100 members of the venture capital and private equity community. A lot of those businesses, of course, really those professionals, very optimistic about the fundamentals, and they're also looking at what's happening in the IPO market. We've had a pretty robust IPO market thus far this year, about 50 transactions. The average deal's up nearly 30% on the first day's trading, so they've done pretty well. Obviously, with the shutdown of the government, a lot of that has been on hold for some of the transactions coming up. But the idea of capital still coming to the equity market, our sentiment indicator is still, in terms of positioning of market participants, still on a relatively muted level. So there's still potential capacity for purchasing there. So those are some of the drivers, both on an earnings perspective, on a capital flow perspective, that would make us pretty optimistic with respect to the trajectory of equities.